Okay, well, good afternoon, everybody. It's after lunch, so, thank you for showing up, and hopefully we'll get some questions and some energy into the room. So Will and I are going to introduce ourselves briefly, and then we're going to talk about something that, perhaps unlike AI, has always been with us and probably will always be with us, which is what happens when things go wrong, who pays for when things go wrong, and how do we keep travelers moving in an industry that has its own share of risk. So I'll start by introducing myself, and then I'll hand over to you, Will, to introduce what we do. This is actually not my first time at this event. Before my present business, I founded a business called Exaris, which was very much looking to innovate in providing payment solutions for B2B, mainly in travel. That business was acquired about 5 years ago, so I've now launched a new business. But even then, one of the really important areas of focus for us is how do we make payments across the travel value chain more efficient. And one of the innovations we did at Exaris was actually work with UATP to create an OTA to airline payment system that was very economically efficient. So you don't have this sort of trade-off between something that was low cost, but really didn't offer any protection against things going wrong, and another product which is based on the usual car schemes, which is more expensive for the airlines, but actually offered protection. And this theme is one that we will sort of riff on today, Will and I. But before we do that, will you introduce yourself?
Yeah, hi. Welcome back, everyone, especially after the chocolate mud cake. It was, may have gone a bit hard. Will Plummer, CEO of Trust My Group. So within the group, we have two main companies. One is TMU Management, which is an insurance MGA covering credit risk in the FX, payments and travel space. And then my day-to-day is running a business called Repaid, which is a merchant of record payment solution specific to travel. So we're all about the sexy things in travel, which are payments and risk, and that's something we're going to talk on today.
Very, very good. Well, Will, so we'll start off by really sort of highlighting what the risks are really in travel, and what it looks like when it goes wrong, if you like, is that airlines do fail. I mean, running an airline is a really difficult business. It's capital-intensive business. It's very sort of exposed to both supply shocks, as we're seeing on the oil price, for example. It's also exposed to demand shocks, as we've seen in the COVID pandemic. So it's a hard business to run, and it's a vital business for many economies, for many of us who enjoy the leisure aspect of that. But there is risk. Hardly a quarter or two goes by without some sort of airline hitting the headlines. The more recent one, Spirit, very legendary airline, I think the very direct line of sight between the Iran war and what happened to Spirit. A couple of quarters before that, we've seen Play, we've seen Eastern Island. It just continues to happen. Some are big, some are small, but it's just a fact of life we all have to deal with. So risk is there in air travel as an industry, and what we'd like to explore really is how is that risk playing out across the value chain, and are there economically efficient ways for the industry as a whole to manage that risk? Because if we don't manage it, that's obviously going to be very disruptive. If we overpay to manage it, that's going to make the industry less competitive. So this is very much around right-sizing this. And perhaps, Will, as a merchant of record and exposed also to the insurance side of the business, maybe you can give your take on the kind of risks that the industry faces.
Yeah, absolutely. And you've highlighted some things there, and I think we can all agree in travel that things change all the time, and with unexpected things coming up. I don't think anyone really predicted the Iran war. We obviously didn't see COVID coming, and that has seismic effects on the industry. And it's only then that you see what the risk is. And I think risk and probably payments in travel for too long has been seen as a very linear operation. It's A to B. It's customer paying an airline directly, or it's customer paying an OTA. But the ecosystem is far bigger than that. What happens down the chain in a travel agency payment to an airline where the airline goes out of business, And then how is that risk protected? How are the acquirers protected? How is the customer protected? You know, in the UK, we've got things like the ATOL and ABTA schemes that are there to protect the customer. But one of the challenges for that is someone's always paying for that. And how often is it that there's duplicate cover for it? You know, you might have a rolling reserve with an acquirer or a fixed deposit. You might have a bond to meet obligations, regulatory obligations. You might have an insurance to protect, a failure. And then the customer might have an insurance. So it's one risk that ultimately we're paying for multiple times. And I think we can do better as an industry by firstly understanding what those risks are. We're going to talk about my favorite word, which is data, but also just looking at the different solutions to that.
Yes, and if you sort of ground this, if you, if there's a problem with your with the booking as a consumer, and you call the Civil Aviation Authority, typically their advice to you will be call your bank, right? Call your bank and get your money back, basically. And that starts a chain of events where the bank says, no problem, here's your money back. They file a chargeback, and then the acquirer of the OTA, if that flight has been booked with an OTA, they receive that chargeback. They look to get it back from the travel agent. The travel agent, might be booking that flight directly with the airline or through an aggregator, but they themselves try to get recourse. And somewhere along, it's a bit like musical chairs, somewhere along the line, somebody ends up without a chair, basically, and they basically lose the money. And that's the source of the risk. And because we've all played this game many times, we've been around the chairs many times, every single sort of player in the value chain is trying to protect themselves, right? And they have various tools to do that. There is a possibility, and I think it's quite evident that there is a lot of duplication of protecting for the same risk. Now, that as a whole increases the cost across the whole industry, and ultimately it makes margins lower in the industry. It makes it really makes the industry less competitive, and ultimately also from a financial point of view less resilient, because low margin industries tend to be less resilient when there are these shocks. Now, we'd like to explore some of the solutions, and Will and I don't quite completely agree on the right mix, but I think that's what makes an interesting conversation here. We would like to maybe spend the next bit going through what the solutions available are to different parts of the value chain. But I think what I'd like to land is putting out the ingredients. Is there a way we can assemble these ingredients to not just cover the risk, but also to make it economically efficient to cover them? And I don't think this is a problem the industry has yet solved in an optimal way. So that's the next bit of it.
Go on, sell me on virtual cards then.
I will start on virtual cards. The virtual cards have been used in the travel sector for travel agents to pay airlines for a long time, right? And they, I think, deservedly have a somewhat sort of negative name with airlines because they're very, very expensive. And some of the figures are eye-watering. If an airline is paying 3% of the value of the flight to pay for a very high interchange card, and their margins are not very far off from that, 3 to 5%, you can see why airlines don't like that. But virtual cards also come with an implicit guarantee, which is basically the chargeback guarantee. So the travel agent is protected in the case of airline failure. They can get their money back through the card schemes. And if you just think about it from a point of principle, the card schemes are providing that guarantee not just in the travel industry, but actually across a whole range of industries, which means they can do it efficiently, right? They're actually a really great implicit guarantor that can operate this guarantee in a very economically efficient way. And the funny thing, and maybe this is perhaps not so obvious, is that chargeback guarantee is the same whether you are using a 20 basis points, 0.2% consumer debit card, as if you're using a 200 basis points, 2% of the value commercial cards that's specifically designed to milk the kind of transactions for all it's worth. It's exactly the same guarantee. So maybe there is a world where the industry can think about, we have a guarantee here which is underwritten across many industries, and as an industry, the travel industry, if it could get use of low-cost cards, we could get the best bits without the worst bits. Right? So that's kind of our house thesis at we very much something we're trying to do in collaboration with acquirers to make sure that they are protected and they protect their travel agents and therefore bring the cost down of withholding, funds, for example, of requiring additional insurance on top and so on and so forth. So that's kind of our take at Weaver, and we're having some sort of some initial success with that, and we obviously hope to have many more conversations. So, Will, what do you think of that?
I get it. I do generally get it, and I don't want to fall out with the card schemes. That would be not good. But the balance isn't right. It doesn't work for me at the moment. You've highlighted the cost. I think for me as well, intrinsically, we are basing everything on a dispute process that was created in 1970 and hasn't really changed. The balance is not right for the merchant versus the cardholder. And now we're moving into a completely new world, and we've touched upon it today, in terms of agentic commerce, and there is no dispute process for that. We're relying on what was created for humans. So you could have this scenario where there is a failure, and automatically there are a whole load of chargebacks, but they're completely unfounded in terms of, the machines initiated it, they can be challenged, it's incredibly costly, it's incredibly labor intensive in terms of the process. And I think the danger is for everything that everyone says about the benefit of VCCs, cards in general, the ease, the way they integrate into a system, the way you can have a single line transaction to then audit, what I contest is why there is such a driven link between the protection and the actual payment method. And I think actually if you decouple that, and perhaps you still use the card rails, but you've got to drive down that price, and I think you've got to look more holistically at the whole protection side of things. And my argument, that's for me where insurance comes in, and it has to be where insurance sits within the value chain, whether it sits with an acquirer, whether it sits, with the actual merchant themselves, but also then on that one transaction, everyone, and there should be an order of stakeholders, could draw on that insurance and could benefit from it. So you're paying one cost and you're covering that. And your cards and your VCCs aren't doing that for me because they're clunky.
They're clunky. Are they fatally flawed, or can they be fixed, do you think? What would you change?
I say this often enough. The dispute process, the chargeback process, just doesn't work in its existing form for a merchant. There is too much power to the issuer, and I think that needs to change, and there needs to be a better balance that makes it more realistic and a better and efficient way of actually protecting the money, not just allowing people to dispute charges. And we're not getting into friendly fraud. Friendly fraud is a whole different conversation. But it's a challenge in the industry that is then adding layers of cost onto that whole payment process. So completely decouple that, take that out, use the card rails if you want to, but the fundamental protection has to come from somewhere else, I believe. Whether that's insurance, whether that's a bond, whether that's a trust account. We use trust accounts as well, just in terms of controlling funds. But there has to be adequate cover, and that's another key point. It has to cover everything, so there are no gaps in it, and then there has to be an order of drawdown and transparency on that.
So I think you touched on there the fact that if every party in the value chain is using some mechanism, whether that's virtual cards or insurance, everyone is covering the costs for themselves, so to speak, covering the risk for themselves and incurring costs to do that. And if everybody does that in the value chain, then you are really mounting costs up. First of all, do you see this as a problem in the industry, that there's a lot of overlapping, if you like?
I'm going to agree with you on this. It's a huge problem. You think of where everybody is protecting themselves, whether it be the rolling reserves that merchants have, delayed settlements in terms of, access to that cash, whether it be insurance policies that the acquirers are taking out, whether it be insurance policies or bonds that the merchants have, it is so thickly layered, and in a claim scenario, it's fastest finger first. Who can literally get on and get in, and who's going to pay for it? And you hope it's not you.
And is that musical chairs context
It's that
again?
musical chair scenario, exactly right.
Who gets left, yes, holding the losses effectively. So maybe, you know, one angle which, you know, we've talked about two ingredients to this, one of them being virtual cards and another one being insurance. Plus the less efficient ones of withholding funds, which nobody really likes. But perhaps there's one ingredient that is, in a way, an efficiency enhancer, if you like, and that has to be data, right?
Yep.
And I know you've been really passionate about the role of data in really trying to create if you like, a uniform visibility of that risk, and perhaps products can be built on top of that to allow for this.
My favorite takeaway, and it's not even from my company, but the I love data luggage tags from yesterday really hit home. It's fundamental to everything, and I think in 2026, for all we're talking about, you know, AI, for all we're talking about agentic commerce, that core data and that core understanding of what is going on is crucial. You know, what is the transaction, who's at risk in that transaction, and then if something happens, where does dispute and responsibility actually sit? And I would challenge some acquirers that while they say they have the data, they don't have accurate data. I would also say there's not enough connectivity between different parties. So from a merchant to an acquirer, to an insurer, to a bond provider, whoever it may be, and there are systems out here. Some of them sit in this room. Olivia, hi. And there are other parties. But that has to be fundamental. There is a challenge. We've addressed this before in terms of who owns the data and that kind of data responsibility, integrity. But I think whether it's through tokens, whether it's through blockchain, and sort of smart contracts, that has to be where the industry is working towards. Otherwise, we will always have this layer of cost and this issue. And as an industry, that we have to look and move forwards and go, well, why are we relying on something from the 1970s when, I think it was the first talk this morning, we're talking about, you know, we didn't even have the internet there. And look at how we've moved forwards. And we're going, right, in 2026, we're relying on that process, and I'm not solely, you know, having a go at the chargeback process, but also there isn't enough connectivity around responsibility. Because if a merchant can go to an acquiring bank and say, in the event of a failure, you're protected by this and that, and this is the order, and there is no dispute that you get paid and you're responsible, then that should drive down cost, that should drive efficiency, and that should improve the whole industry.
I think the point about data is really well made, and you know, from personal experience, you know, at Exars we went through many airline failures, Flybe, but the big one was Thomas Cook, and what we found in the heat of the moment, as you said, Will, it was everyone trying to get hold of the money so that they're in the money, is that these disputes got challenged back by the parties upstream, and in many cases the data to support the challenge, even though clearly everyone knew Thomas Cook couldn't honor the bookings, many were caught out by having chargebacks that were actually failed. The process was incredibly labor intensive. It took months of presentment, representment, going back and forth, money moving back one way, moving back the other way, and it was it really exposed how poorly equipped, to your point, the industry was. There was the sense that, oh, we've used virtual cards, everything's going to be all right. And in fact, it was not all right. It was very labor intensive, and many were caught unprepared. And the missing ingredient there was precisely that, the data. And I think this leads us to, I think, perhaps the next bit before we open for questions. Often it's really about having things joined up. If everybody lives in their own silo, and lives in this world where they cover for themselves, or they think they can cover for themselves, then often what happens is that the party along the value chain that's least prepared of that is the one left basically without the chair, so to speak. We have an opportunity now with all the tools that we have, including AI to help us with processing data in a much more automated fashion, is to start to have this sort of data hygiene in the travel value chain, where everybody knows what their commitments are and what the commitments are from the suppliers that they've made at any point in time. And I think that gets us all into a place where we can operate this value chain much more efficiently. Now, I happen to think that cards, and with the implicit guarantee from the card schemes, maybe a modified chargeback process that is more fit for purpose for the industry might be a good part of the answer, because there's a lot of investment in that infrastructure. If it can be made to work economically, it does also give the opportunity for cash flow to work really, really well. That in principle, the supplier, the airline, should be able to get payment the next day after the booking has been done, or maybe even in real time. In practice, because of the risk involved, they often don't get it at that point, and they have to fund working capital. So I think there's a lot of work to do in the card instrument, but for it to work much better, we should actually have this source of data that we can all agree is the closest to the truth, not your version of the truth.
Yeah, I think you're right. And it probably does start, certainly in this part of the world, with the card schemes, not just in terms of virtual cards, but accepting consumer cards as well. I think you've got to be looking to the card schemes to drive a data standard. I don't think that's ever been done. They've talked about getting data and the benefit of it, but we should be collectively being driven to a data standard of certain things, which then probably it's carrot and stick. There's a benefit in terms of the cost of actually acquiring. If you then cover off your exposure for the acquirer, for the schemes, you should see that sliding scale. I think where I struggle a little bit with the cards is that chargebacks are such a blunt instrument, and I just think there needs to be a refinement. Using your Thomas Cook example, there should never have been, if you had the data, there should never be dispute that the airline has gone out of business, you have got a valid booking that is not going to travel, and you have a right to get your money back. Money should have gone back straight away. Should be there on that. Who pays for it? That's a question that has to be asked in that whole value chain, but that shouldn't be a dispute. The challenge is obviously, if you don't have that data, you've got people that didn't fly, that flew earlier, already had a refund, and you don't have that transparency. So we've got to drive to that standard, because once we do that, what we can then do with it is immense. The tools that we can add, whether it is chargeback protection, whether it is insurance, whether it is holdbacks, you have a total picture, and you just have a better industry that just works more seamlessly. And it's only getting more complicated. And I think that's the challenge. I said at the start, we look at things in payments as being very linear. I think we're still looking at them as being linear, and they're getting more complicated than they've ever been before, with more players and more risk that is being paid for multiple times.
No, I think that's right. I think the takeaway for me is a very optimistic scenario, which is we have the ingredients, right? Insurance is a relatively recent innovation, airline failure insurance, and it really does help the industry to work better, right? So we have basically tools, including virtual cards, including the implicit guarantee, maybe an improved chargeback process. We've got insurance, and we certainly have data around. It just needs to be better coordinated. And it's great to see the industry in the industry data products that are really solving for this, aggregating data from all sorts of sources: the airlines, the bookings, obviously the car transactions as well, to be able to provide that authoritative data set. So I think in the next period, it'll be really great to see how these ingredients can be put together into industry-wide solutions, so we can get on with the business of, in an inherently high-risk world where the unexpected happens, we minimize the impact of these sort of events, and we keep travelers moving.
Yeah, I think you're absolutely right. And there's got to be that connectivity. There's got to be an agreement on how that kind of works. Because I think private companies can still make money out of what they do within all of this, but there has to be that standard and that connectivity and responsibility to that connectivity to actually play.
Absolutely. Brave new world. We've got a couple of minutes for questions, if anybody would like to ask us anything about what we've covered.
At the back.
The cake. Oh, we have one. Oh, somebody who didn't have the cake.
Alex Kelly from Tribe. That's very loud. This may be a very stupid question. It's really weird. He yourself back. When you talk about the risk being covered multiple times in the chain, do you see there's any value in things like the scheme fees being effectively an insurance on that? So the percentage of that transaction is taken and it's used by the schemes as a central mechanism to pay out that charge back to make the decision. There's probably millions of holes in this, but I don't know if you see that there's any value in that or it's a terrible idea.
I think it's a great idea. I mean, I think the more we can do in terms of things around that to protect everyone in the value chain, it probably does, as I say, in travel in this part of the world, cards are the place to start with all of this. So if we can put something there, and if people contribute, if you were able to say to a tour operator in the UK, for instance, who has to meet regulatory standards, and they might want to take out supplier failure insurance, if they could either put that on the card processing or make sure that the schemes were a beneficiary of that insurance and they get some benefit to it, then it works as far as I'm concerned. But there isn't that thought and connection.
I mean, ultimately, what works really well is if you can spread the cost across as large a base as possible. That's how insurance works, right? And insurance is a scale product. The more sort of customers that get insured, the lower the economics of providing that insurance is. So anything that can do that sort of aggregation of risk has got to be good for the industry. So
insurance is the answer. You're saying insurance is the answer?
Some form of insurance, whether that's directly as a standalone product, or maybe it's something that's implicit in the guarantees that can be provided by the schemes. I think there's a genuine opportunity for the car schemes. They have made, I think, good money from serving the industry, but I think it's also clear that there are some challenges with the economic model of the car schemes, and I think they have every opportunity and every ability to really create better products for this industry that work for everybody in the value chain.
All right. I think that's it from the audience. I think so. Okay. Well, thank you guys. Appreciate that.